Hello everyone. What if you had invested in the Nifty at any random point of time since its inception? What were your chances of making a positive return? Well, if you had held for a 1 year period, that probability is 70%, 70. If you had held for a 3 year period, that probability rises from 70 to 86%. If you had held for a 5 year period, that probability crosses 90%. And if you held for a 10 year period, the probability of you making a positive return is as much as 99%. Basically, it goes to show that if you buy and hold for long periods of time, then the chances of you making a loss in stocks, in equity, are quite low. And this is particularly true if you hold a diversified portfolio like the Nifty itself. Here again, if you had bought and held for a 1 year period, your chances of beating a 12% threshold are 52%. If you had bought and held for a 3 year period, your chances of beating this 12% threshold, they rise to 63%. And if you bought and held for a 10 year period, then your chances of beating the 12% threshold, they rise to as much as 68%. That's a pretty good probability of beating a high 12% threshold if you had held for a very long period of time. Now, all of this is data of the Nifty since its inception. In terms of a back test, this does not mean that it will necessarily hold up in the future, but usually if you look at past returns, it offers some indication, some general idea of what equity returns can shape up in the long term. Amidst all this, there is one caveat. There are stock markets like Japan which have not given any return for decades together. Japan peaked sometime in the late 1980s, and until 2012, until the launch of Abenomics, it was on a stagnant to declining path. However, in case of India, we have no reason to think that it would go down the same path. Another way of estimating this is to look at the nominal rate of GDP growth. The nominal rate of growth is just the real rate of GDP growth plus the rate of inflation. So if you estimate that the real rate of GDP growth of India over the long term is 5% and the rate of inflation is also 5%, then the return on the stock market should roughly be 10%. Of course, these numbers can change depending upon your estimates, but roughly speaking, this serves to reassure us that the long-term returns on equity will not be too bad. One final caveat in all of this: the long-term returns on equity do get affected by your starting valuations. If you invest at a time of an overvalued market, then it makes a difference between getting, let's say, an 8% return compared to a much better 12% return. Something to keep in mind.